What is going on, you guys? Welcome back. A common question I get inside our real estate community is how am I navigating the current market? It's really volatile. Should I be switching my strategy? Should I be doing more rentals? What should I do? And so in this episode, I'm going to tell you exactly how I answer that question every single time. And I'm going to give you everything that I'm doing in the current volatile market. And I hope you enjoy. Who am I? My name is Ryan Rice. I'm a full-time real estate investor, and I'm an ex-Fortune 30 W-2 employee who did over 7 figures last year. I share this stuff with the hopes that it makes you some more money in real estate. Something I'm currently watching right now is simply the 18-year real estate cycle. Since the early 1800s, the real estate industry has moved in 18-year cycles. And for those of you who the 18-year real estate cycle is new, basically what that cycle is about 6 to 7 years of very slow growth. There is some sort of mid-cycle dip around that time. And then for the next 6 to 7 years, there is what's called an explosive phase where the real estate prices significantly increase. And then there's another, after that, 3 to 4 years of a real estate market decline. And this 18-year cycle has repeated itself many, many times since the early 1800s. And so it would seem to be somewhat wise to consider that it could continue to happen. And so that poses the question, well, where are we in the cycle? Well, the last real estate crash was in 2008. It took 3 to 4 years for prices to fully decline, and we started recovering around 2013. So if 2013-ish was the start of the news cycle, that aligns pretty well with what's been happening nationally with real estate prices. And look, for the record too, I have no idea what will happen. I'm not a doomer. I don't think that, everything is going to fall to zero. I think it's simply beneficial for me to be aware of what has happened in history and be prepared that if history repeats itself, which has happened many times every 18 years since the early 1900s, then I should just be ready for that. The cool part about real estate for us is real estate moves slow, much slower than the stock market. On average, it takes about 12 to 36 months for us to see some sort of real estate decline. And over the many past 18-year real estate cycles, we see an average of a 15 to 20% price decline in the real estate industry nationally. And for perspective, during the Great Financial Crisis 2008, real estate dipped 27%, which was one of the biggest dips that's ever happened. And now that was on average. The worst markets in real estate saw as much as 60% dips. And so I think it's important to understand what type of market are you in. Are you in a Sunbelt market, which are historically more susceptible to bigger dips, or are you in some sort of Midwest or smaller real estate market where those markets are not as susceptible? And so literally 5 to 10 minutes on ChatGPT will benefit you. Just go do some research on what's happened in your market in the past real estate declines, and that can help kind of give you an idea of what may happen in the future. Now, what's also beneficial about real estate is stocks always go first. And so if there is some sort of big economic crash, stocks will fall first, and that's a good indicator that real estate may follow. And the average decline of the stock market in a big crash is around 44%, which is greater than what we see in the average real estate decline. And so I share all of that with you, not to scare you, not to predict that I think it's going to go down, but just to simply communicate what has happened in history so that you can be prepared if history does repeat itself. So how is that changing my behavior? What am I doing differently considering where we may be in the 18-year real estate cycle? Well, I think first, I'm just not buying really large projects. I'm not buying projects that are going to take 8 to 12 months of construction. And there's just a lot of uncertainty in what may happen. And if that means I have to pass up a really big potential high profit deal, then so be it. I am taking down projects that I know I can get in and out of in 3 to 6 months. And the likelihood that there is some sort of significant real estate move in a 6-month period is very minimal. And so, if I have to buy projects considering, maybe 5 to 10K conservatively, I just need to have as a buffer in the event there's some sort of macroeconomic issue, then I can do that and I'm ready for it. Another thing that I'm doing is I'm cross vetting a lot of the deals that I take down with some of the greatest real estate agents in this area. And so I'm just being ultra conservative. And if I'm seeing certain data and I know the markets well, I'm just testing my hypothesis of what that ARV is going to be with some really, really good local agents who have also done deals in those areas. And I would say a good, so far, 99% of the time we're aligned. But if there are any discrepancies, or if I have an extra set of eyes, then that's just another layer of me helping to mitigate my risk. And I've talked about this a lot. And if you haven't heard this, listen to this episode, go listen to the new way to pull ARV. Essentially what I'm making sure, and what's especially important in periods of potential price movement, is look at what's active and contingent on the market. Don't just go straight to 3 to 6 months sold and say, we had 3 houses, they all sold for 300, so my ARV is 300. Well, if that's the case, but you have 10 homes on the market and they're all listed at 290 and they're not selling, well, that should change your behavior. You should do something different. And I've seen where that has occurred in some markets. I've seen where that's occurred in some areas. And I'm just extra cautious and I'm extra conservative of that. So be sure you're looking at what is currently on the market, and then what are people actively buying in the neighborhood where you're looking. And you can do that by clicking that contingent button and seeing how many people are buying homes in the area that you're looking in. The next thing that I'm doing a little bit differently, and I've been talking about this for a few months, but I'm continuing to do this, is I'm doing what's called wholesale more. And wholesale I define as I purchase, I do very minimal renovations, if any. Maybe I just clean and I list it back on the market. And I've seen that be very beneficial over the last few months. And I'm continuing to do it. I'm buying another one on Friday of this week, and I'm going to purchase it. I'm going to paint. Maybe I refinish the hardwood floors, and then I'm going to put it back on the market. Right. So very, very minimal work. And I'm going to have that thing on the market within 2 weeks of when I purchase it. The reason I see that strategy as beneficial is, number one, it significantly decreases the amount of hold time. And number two, when you're bringing the property to market, you can bring it to market at a price that's a little bit lower than what all of the renovated homes are selling for. And what that means is it's going to increase the amount of buyers who are able to afford that house. And I've seen that as beneficial. Because of where interest rates are right now, the lower the price, the more someone can afford. And if a home comes to market and it's cheaper than a lot of the other fully renovated homes, well, that might be an opportunity. And maybe it's perfectly livable, it just doesn't have brand new white shaker cabinets and granite countertops. Well, someone is probably okay with that. And there's more people okay with that right now than who want like a fully renovated home because interest rates are 7%. And so that strategy has proved well just in the retail market because more people can afford the home. Another reason I think wholesaling has worked well is because there's still a significant amount of what I would call retail investors. A retail investor I would define as maybe someone who has another full-time job, wants to get into investing in real estate, and they're willing to pay significantly higher prices than people who do this for a living, who manage their margins and are relying on a certain percentage of profit to make a living. People who are doing it on the side, they're much more comfortable making significantly less on those deals, and so they'll pay more. And so even deals that may need to be flipped, and I'm taking down and I can list those for sale, I have found people will pay significantly more. And I'll give a quick example. And those of you that listen to this channel, this won't be new, but I bought a brick rancher in a really desirable area last November. All I did was clean it out and list it for sale, and it wasn't really livable. It needed to be fixed up. Well, I felt comfortable paying about $140, and there was an issue with the house, maybe like $135 to $140. There was an issue with the house, and I ended up getting it discounted. I bought it for 120, 115 or 120. And so I listed it for 150, thinking that would drive a lot of attention. And I got several offers from retail investors in the 180 to 200 range, and it sold for 200. Right? And it sold for 200 from someone who's not doing real estate full time. It was a business owner, and he just wants to invest some money on the side. There are a lot of those people right now still investing in real estate, and we can take advantage of that by wholesaling. They might not be regular buyers that we're constantly sending deals to off market and we're wholesaling to, because we're unaware of who they are, because they're these onesie twosie type retail investors. And the only way that those retail investors know how to find deals is they look on the MLS. And so that has been another reason why wholesale has been effective for me, and I'm going to continue to do that strategy. And then lastly, I'm just continuing to wholesale more. Last year, I think I started to veer a little bit more towards maybe I buy two and wholesale one, and I'm back a little bit more towards wholesale two and buy one. And I'm probably going to continue that trend just for quicker cash flow for the business. But as well as I do think that mitigates the risk of any potential macroeconomic event or any potential price declines that may be happening in the market. So long story short, the potential and the current volatile market doesn't need to scare you. As long as you're informed and you understand that, one, real estate doesn't move very quickly, and then two, if you are buying a home, just get into a quicker project so that you're not holding it for a really long time, so that you don't have to worry about the uncertainty in the long run and you can get in and out. Well, your risk is going to be relatively low. So do some research on your market, figure out what kind of market am I in my market, what has the history of price declines been, and is it a little bit more stable or is it a little bit more volatile of a market? And if it's more volatile, then you need to be more conservative. And then just be sure that you're looking at the active and contingent inventory. Is there a whole lot of stuff on the market currently? Are there a whole lot of buyers buying stuff in the market currently? And if not, then you can make an adjustment. But I don't think there's a need to be fearful. Someone asked, am I only buying rentals now? The answer is no. I'm still buying properties that I intend to flip, and I'm just thinking about it in a little bit different of a way. So hope that was helpful. If you've had a conversation with someone recently about the state of the market and you think the person who you talk to would get some value by listening to this, then please send it to them. That's how this podcast grows. And I appreciate you guys continuing to share it. So hope you all enjoyed that, and I'll see you in the next one. Peace.